I welcome you to this new series which I've designed for the businessman, the entrepreneur, especially the aspiring startup entrepreneur. Is about the decoding of key financial and business terms. I'm Ajoy Basu. I'm motivated to prepare and present this capsule in the light of my long experience as a professional and as a mentor and a trainer to so many. I thought let me bring forward some of these in this capsule, in this series of capsules, which I'm going to put forth going forward. I present you with a scenario. You're running your own business. Your accountant submits the monthly MIS, the Management Information Report, or financial statements. Or you get into the financial report section of your accounting software and extract the balance sheet. Your eyes spot the accounts receivable at an X amount. This presentation is about how you need to train yourself to look at this figure, and also beyond, besides, and differently. What sort of analytical competencies you need to invoke when you stare at this vital piece of statistic. Even as I look at the figure of accounts receivable for the current period, I need to have a ready look at that of the immediately preceding period, or for that matter even at the one before that. In analytics, anything is good or bad only by comparison. Plurality or multiplicity of figures is a must. The debtors turnover ratio and debtors velocities are important. The debtors turnover ratio tells me how many times the average debtors have turned over in relation to the sales. Higher, the better. Whereas debtors velocity tells me the number of days of sales represented by debtors. We commonly call them as number of days of accounts receivables. Lower the better indicates better efficiency in the collection process. Of course, all the above statistics need to be evaluated with a knowledge of what prevails in the market and whether we have been able to better the normal market or industry trend. We continue our analysis in the next slide. An area of major concern for me would be the amount of sticky receivables, those which are difficult or even impossible to realize. While the absolute values do matter, its percentage to the value of total receivables will be critical, as it reflects both on the creditworthiness of my customers as also our collection efficiency, big area for reflection for any business. I need to also evaluate as to what is the cost I pay for providing extended credit to my customers. This has two aspects to it. For the period of credit, what is the percentage of interest I pay to the bank? Also, whether I get equivalent credit from the suppliers so that it gets balanced out to that extent. During the working capital evaluation for my clients, we often discuss about the carrying cost of receivables as a percentage to sales vis-a-vis the gross profit percent to sales. It should make business sense. We then evaluate how much of cash discount we can offer to the customer for an earlier payment so as to positively improve the turnover ratios and the velocity days, thereby contributing to the scale and profitability of the company. These discussions are interesting and crucial. We come to the third slide with some more points of analysis on accounts receivables, or what you call as sundry debtors. At times I have seen that the trade receivables, or the sundry debtors as we say in this part of the world, get inflated or skewed due to inclusion of non-trade receivables in it. The data needs to be scrutinized for that before being analyzed. Otherwise, the decisions which you base on that could be flawed. During the brainstorming sessions, I insist on the credit rating and market intelligence reports, even if rough and informal for a smaller business, of customers with large balances. This forewarning mechanism to regulate the creditworthiness has helped tackle many a dangerous continuing exposure for my clients. If we remember the adage, a stitch in time saves 9. Finally, the acid test, the test of death as I can call it. If the very sticky advances were to go bad, how does it impact my net worth? It's a contingency valuation, but important. And going further, how does it affect my solvency in the immediate and longer operating cycle? It is advisable to look at an impending reality straight at the face so that you can take mitigating steps when you really can. I trust you have enjoyed this new series of reading beyond the immediate in respect of select financial figures in your financial statements. Do post your response, as I plan to create more presentations on such critical components affecting your business. Thank you for watching this presentation.